So if we were to compare between a whole life policy and a term policy, okay, if we were to buy the traditional type of whole life, it costs a lot just to cover us for $1 million, right? You can expect to pay as much as $2.3 thousand, which is almost 25% of Peter's monthly income. If he opts for the multiplier plan, right, which is the newer type of whole life policy, it goes down significantly because the bulk of the coverage actually comes from a so-called term policy, so $660. A term policy that covers $1 million can cost as little as $100, and therefore that's our recommendation to how you can cover for $1 million of coverage, because it's not quite cost effective to go for whole life policies to cover $1 million of sum assured. And that's very important because during the financially productive years, we do need that much, or rather, Peter does need that much to cover his dependents. For income due to disability, we have to go for disability income insurance. This only comes in the form of a term policy. You can possibly add it as a rider, or you can buy it as a standalone plan, and it costs around $134 per month. You can also add it to a whole life policy as well. For income replacement due to medical crisis, we can use a rider to add on to a whole life plan, and that will cost anywhere between $300 to $400 depending on the type of policy you're opting for. For term policy, we can add on a rider to our plan at $186, roughly half the premiums of whole life policies. And therefore, that again is our recommendation to go for a rider on a term policy. With that, we have actually covered the bulk of Peter's temporary needs, and then we move on to things like medical expenses. He can opt for an integrated shield plan, and if he wants private hospitalization, he should go for those which are pricier. If he thinks that restructured hospital A ward is good enough, he can opt for that as well to manage his budget. And to fund for medical expenses, he can opt for a combination of whole life policies and term policies rather than just buying whole life entirely. So this is what Peter can actually opt for for his insurance needs. He can buy actually a term policy plus a whole life multiplier plan. So he can start off with an $800,000 term. So instead of covering $1 million with either a term or a whole life, he can go for $800,000 term, which costs roughly around $100. Get disability income to cover his $7.5K of monthly income, and get a term rider of $400,000, and this will cost around $149. So with that, we actually covered most of Peter's shortfall during his financially productive years, and then we add on a whole life multiplier plan of around $100,000 sum assured with a 2 times multiplier. So what this does is that it will actually combine with the term policy to give you $1 million of death coverage before age 65. 7.5K of disability is provided by his disability income policy, and he will have $600,000 of critical illness, which covers him for 4 years of income loss, as well as about $200,000 of buffer. Now, after age 65, his term policy will have lapsed if he did not make any claim on it, and his multiplier plan will pay around $200,000 of sum assured, and soon after that, it will fall back to $100,000 because the multiplier will have ceased. So this accomplishes a few things. During our financially productive years before 65, we actually get a high amount of coverage against death, which our dependents need, disability, which we need if we are disabled, and critical illness if we were to fall severely ill. And after Peter retires, he still has some amount of coverage for critical illness to tide over unexpected medical expenses during his old age. And this will cost around $700 with about half coming from the whole life plan. So if you're someone who's really on a tight budget, what you can consider doing is actually to cover your immediate needs first using term insurance, and that will actually cover the bulk of your needs. And then if you have more budget in future, to add on a whole life coverage, which will take care of things that happen only after 65. So we try to address immediate needs first, and that is what happens before retirement.